Hi, this is Constance from ZUA. Today we're going to talk about travel allowances and reimbursements. A travel allowance is any allowance paid or advance given to an employee in respect of traveling expenses for business purposes. The general position is that private travel is taxable and business travel is not. Fundamentally, the legislative framework makes provision for two scenarios. Firstly, a travel allowance. A travel allowance is given to an employee to finance transport, which in the ordinary course would be a set rate or amount per pay period. There are two inclusion rates for purposes of deducting employees' tax, or generally known as PAYE, namely 80% or 20%. The standard withholding rate is 80% unless the employer is satisfied that at least 80% of the use of the motor vehicle in question will be for business purposes, in which case the inclusion rate is only 20%. So whatever is included in what we call the inclusion rate is what is taxable. Reimbursive travel allowance. A reimbursive travel allowance is an allowance paid to an employee for actual business kilometers traveled according to either the SARS determined rate, which is R3.82 per kilometer currently, or as determined by the employer. Reimbursing an employee on a higher rate, which will increase the employee's PAYE liability and may result in lower employee take-home pay. The taxpayer would need to keep record of the date of business travel, the business kilometers traveled, the business travel details, where to, and the reason for the trip in a form of a logbook. SARS has provided an acceptable format for a logbook. There are two methods of calculating the deductible amount against the travel allowance. Firstly, the actual cost model. Now, this method requires accurate information in the form of receipts, tax invoices, and other relevant source documents. For the purpose of finance charges and wear and tear expenses, the maximum vehicle value is 665,000. Business kilometers divided by total kilometers times total cost is equal to the allowance claimable. Then there's what is called the deemed cost method. The deemed cost method comprises three components: the fixed costs, the fuel costs, and the maintenance costs. SARS provides a table from which the taxpayer determines the appropriate deemed cost elements based on the vehicle value. Cost per kilometer times business kilometers is equal to the allowance claimable. If this all sounds quite technical and you require our services, well, ZUA provides a wide range of services. Why don't you reach out to us for an in-depth discussion should you require any additional support from us? You can call us, send us an email, or contact us via our website. We look forward to hearing from you.